Alright, morning everyone. Welcome back to Compound Interesting. This is Emil, and in today's video we're going to run through 3 growth stocks that I've been buying or that I've been watching very closely recently. Now these aren't my 3 highest conviction stocks, these aren't my biggest positions. These are ones that are low cap, so they have enormous potential rewards, but maybe a little bit more risky, so just keep that in mind. They're not my biggest positions. If you want to know what my biggest positions are, I'll link a video up there of my biggest conviction stocks and my biggest positions. But anyway, with all that said, yeah, obviously these are a little bit more risky, so proceed with caution. They have enormous potential. And the first stock of the bunch, straight away, let's get into it, is Lemonade. So Lemonade is a stock that I analyzed before. I opened an initial position into it, and at that time I made a video about it. I said that I was opening an initial position, so I bought in at like $82. And I was like, okay, but I think it's a little bit exuberant, the price, so I'm going to be keeping a very close eye on it. And if it drops, I'll be happy to buy up some more shares. And it's been dropping and dropping and dropping. So it IPO'd at $29. Within the first day, it went up 140%. So from $29 up to like $80, and then it topped out at like $90. I bought it at like $80. Now it's dropped down to like $50. So I've been very interested watching it. I bought more at 60, I bought more now at 50. So I got the pullback that I was looking for. So let me explain to you what Lemonade does and why I'm very bullish about it. So Lemonade is trying to disrupt the very legacy, old insurance industry. So they're kind of a new up and coming insurance platform. Now the insurance industry is one of the biggest in the entire world. And in the USA, it makes up 11% of the GDP is just from insurance companies. And a lot of those insurance companies are like literally well over 100 years old. So yeah, they're good at what they were doing because they've lasted so long, but maybe it is time for a bit of disruption. So we're keeping an eye on Lemonade because potentially it's doing some things that they're not doing that could potentially bring a lot of new customers on board and delight those customers. So what Lemonade is really trying to do is, because everyone hates kind of going to their insurance, trying to get a claim, because it's such a hassle, or everyone hates joining a new service or swapping service insurance providers because it's always such a nightmare. Lemonade wants to delight their customers. That's their whole business model. They're really trying to make it so their app's so great for you, the customer, and they use AI to make claims really fast. So say my house gets broken into, they steal some things, I go onto my Lemonade, tell them what happens. They have they're building up their data now. Their data's just starting. But if you know anything about artificial intelligence and data, the more data you get, the better your AI becomes. So over time, it gets exponentially better. So right now, their AI was losing them a lot of money. Basically, what their AI is trying to do is correctly price people's insurance premiums. So how much they pay per month. The AI works out how much I should pay per month to Lemonade for a house with this many square feet, etc. And the AI also picks up, like I could tell the AI, I just type in what happens and the AI decides whether it's a legitimate claim or not, and it's getting better and better at doing that. And because it's a robot, you don't need to do all that paperwork. You don't have to send off a lot of things and wait 2 weeks or even months to get your claim back. You can get your claim back within seconds, literally. So a few €100, they'll just send it to you, and it's working really well for them. But with time, this will get better for sure, because that's the way AI and data works. So yeah, the insurance industry is an enormous industry, $5 trillion in annual revenues worldwide. So Lemonade with a market cap of less than 3 billion, like definitely there's plenty of room for Lemonade to expand into. However, at the same time, it's not really getting much revenue right now, so it's really in the very first innings of its growth. It's not a big company at all yet. It's a really extremely small company in terms of revenues that went IPO. So it's a really high price to sales ratio of 33. So that's a very high price to sales ratio. And it's actually the most expensive stock out of the bunch today. However, it's also the fastest growing, and it's growing grew revenue 141% year over year this year. So that's extraordinarily fast growth, obviously, and 100% customer growth year over year. So not only are they growing their customers over 100% a year, but the amount that the customers are spending with them, each individual customers, is growing as well. So you always want to see the average revenue per user growing as well as the number of users growing in any sort of business model like that. That's a double whammy of growth. So that's always great to see. The other point that I really like about Lemonade is that they're going after younger people and a younger customer segment than the legacy insurance companies. As they say in their investor presentation, legacy insurance companies, the way they get people to switch is to say, oh, Jim saved €100 on his car insurance with whatever company. And they're always going after 40 to 50 year olds. However, Lemonade's going after that 30-year-old or thereabouts age range with renters insurance, because they know if they can get the renters onto their platform now, insurance is a really sticky business because it's a pain in the hole to change insurance providers. And it's also, if they can get those people on now, give them really good customer service, give them back all their claims, and just delight them. That's their whole business model, to delight their customers, make them feel real special and appreciated, etc., etc. If they can offer really good customer service to me as a 30-year-old or whatever, I'll stay on their platform. And then once I start earning a lot of money and stop renting and move into a big house and buy a fancy car and start spending a lot more money on insurance, I'm still going to be using Lemonade. So this is a really, really good long-term play. If I was a short-term investor, I wouldn't really be interested in this stock at all. But if you're looking 5 to 10 years out, when Lemonade's current customers start turning into, adults, proper adults with kids and etc., they're going to start really making some bread then. So stick around for that if you're interested in Lemonade. But obviously a very, very risky one, and will be very volatile in the short term. All right, let's go on to the next stock. All right, so the next stock on the list today is Xero. Now, Xero is a stock you probably haven't heard of, but it's an accounting software company. So they create cloud-based accounting software for small businesses and also accounting firms. So I work as an accountant, so this is kind of an inside scoop for you guys that I'm happy to share. But my partner was talking to me and he said he wants to get me trained up on Xero because all their customers want to use Xero and are starting to use Xero. So Xero is an Australian company, so it's based in Australia and New Zealand. I think it's actually set up in New Zealand, but they have really good market share in Australia and New Zealand. But now they're expanding into the UK and Ireland, so that's why I'm kind of getting the inside scoop here. But eventually they'll hopefully migrate into North America and the rest of Europe and start to really expand into those other markets. So the few things that I really like about Xero, and there's a few things that I don't like about Xero. So let's start with the good points and then the couple of bad points that are the reasons I haven't actually invested in Xero yet. All right, so working as a young accountant, I've just started working as an accountant. I'm really used to, modern softwares and, apps and everything. But the accounting softwares that I'm using in my firm are really old fashioned. They're not intuitive to me, but Xero seems a lot more intuitive and a lot more easy to use for a younger person like myself. To add to that, I was manually putting in, or we still do this, manually put in bank transactions for an entire year and manually put in invoices for an entire year into an accounting software to create our accounts. However, with Xero, you can actually put in the bank transactions and the invoices, automatically scan them or whatever, put them into the Xero software, and they'll build out the accounts for you. You don't have to manually put in everything, which saves literally weeks of work. So when I saw this, I was like, okay, this is obviously a game changer. Because when I was doing that, manually putting in everything, I was like, what on earth? Like, surely there's a better way to do this. And then along came Xero. So that's where I started to get interested in Xero, because it just makes so much more sense than manually doing everything, which takes literally days, if not weeks. Also, the fact that it's cloud-based means that there's a lot less paperwork, there's a lot less papers that can go missing. Everything can just be searched up and everything's in the cloud, so you can access it from anywhere. So that's obviously a lot more intuitive for modern business and modern, clients or whatever. However, there is some problems with Xero. So I looked up Xero, I wanted to see the reviews, and there's a couple of competitors. So there's QuickBook and there's Sage, and there's obviously a few more competitors. But Xero doesn't get the very highest reviews and sometimes gets some bad reviews because they're not putting enough money into making the software excellent. I feel they should be putting all their money into making the product the very best product out on the market. But in my opinion, they're putting too much money into advertising, sales and marketing, which is making their growth really good, but if they don't have the most perfect product, I don't think that's as good as a business model as just making a really fantastic product, and then the product would sell itself, somewhat like how Tesla doesn't even advertise at all. However, Xero is spending a lot of money on advertising, which is one point I don't like. The other point I don't like is obviously that it doesn't get great reviews, and because it's a cloud-based accounting software, when you're inputting stuff, it doesn't directly just go onto your computer. It actually goes onto the internet, onto the cloud, which takes a bit longer than just going onto your computer. So there's a bit of a lag time, and it's not as fast as some of the more legacy accounting softwares. So because it's an Australian company, I have to pay a high transaction fee. If I wanted to buy some Xero stock, I have to pay $10 for every purchase, and I like to do, really small purchases at a time. I don't like to buy a huge amount all in one go. But with Xero, it looks like I'm gonna have to buy a considerable amount for me in one go. So that's why I haven't bit the bullet just yet, and the other reasons that I've mentioned. However, cloud-based accounting is definitely where the future is headed. The legacy accounting softwares are going to have to switch to cloud-based, or they're going to get eaten up by the likes of Xero. And the more I start using Xero, I'll be able to get a better picture of how good the software actually is. And if the prices start getting to a lower valuation, or at some stage I'll probably just have to, bite the bullet and actually buy some of the stock. So running through a couple of the numbers quickly. So the market cap is $10 billion. And here on the screen, you'll see that that's actually in Australian dollars. So that's why it's 16 billion there, but it's $10 billion in US. The revenue is growing at 40% a year, which is really, really fast, really high growth stock. So that's great. Their balance sheet is grand. It's okay. Nothing absolutely amazing. And their price to sales ratio is 23. So also a really, really high price to sales ratio, but not as high as Lemonade. But then again, it's not growing as fast as Lemonade. All right, before we get to the last stock, I would hugely appreciate if you could smash the thumbs up button, subscribe if you haven't already, and my videos aren't getting very many views at the moment. So a lot of my subscribers aren't getting the videos into their recommended feed. So if you are a subscriber, make sure you hit the notification bell so you'll actually be notified when I release a video, because YouTube isn't pushing my videos at the moment. That would be hugely appreciated. So let's get on to the very last stock. And the very last stock on today's menu is Upwork. All right, so if you don't know what Upwork is, essentially what it does is, if I'm a freelancer, I can go offer my services on Upwork, and a company can say, we'll get a load of different applications, and they'll choose me to do some freelance work. So it's a freelance marketplace essentially, and personally I think the freelance economy is going to continue growing for a long period of time. A lot of millennials don't really like working for a company anymore. 87% of millennials would prefer to work freelance. So 87% of people would prefer to work freelance, and there's an enormous amount of advantage for both an employer employing freelancers and for the freelancer. So the advantages for an employer to hire a freelancer is, say they have sporadic jobs that they need done, but they don't have consistent work doing one particular task. It'd be much better to hire a freelancer. Also, it means they don't have to hire and train someone. They don't have to train someone. They can just pick from the very best people in the world and spend however much they want to spend on that particular task. So they can literally get the best person in the world at that task to do the job for them if they want, but obviously it will cost more money. And then again, they don't have to pay benefits, they don't have to pay holiday pay, sick pay, etc. And they can just pay once if they want, if they just need one job once off. Also, there's enormous advantages for the employee or the freelancer. You can work from anywhere in the world. So I could work from Bali, be getting all my dinners cooked for me for €2, live in a class apartment, because all I need is internet access and the knowledge and skills that I have. Also, I can charge however much I want, and you're more than likely going to be making more per hour than if you were working full-time in a job. If you're been freelancing for a while, say you're getting sporadic jobs, you're probably going to be able to charge more per hour. So you'll maybe get less work overall, but you'll be charging more per hour than if you're working in a normal job. And to add to that, you can price your services at whatever amount you want. So as you gain experience and as you gain testimonials, you can increase your prices and continually increase your prices until you're not getting any more jobs, obviously. But you can charge however much you want. But if you're in an actual job, if your boss doesn't like you or doesn't see the value that you're adding to the business, you might not get that raise for years and years, and the raise is only 10-20%. Whereas with a freelance job, you can essentially, there is no ceiling to how much you can charge. You can become the best in the world and charge an enormous amount for it. So I'm sure if you're at all interested in this industry, freelance economy, you've heard of Fiverr as well. So I like both of these companies, and it's difficult to choose between one or the other, which is the better investment. For me, I'm going with Upwork, because Fiverr at the moment is so Fiverr, if you don't know, basically it's kind of for less professional people. It's kind of for side hustlers, but they're kind of charging a cheaper price. So I can go onto Fiverr, I can get a logo made for me for like $5 or $10 from a guy in India or whatever, or a teenager who's good at graphic design and does it after school for me. It's slightly less professional than Upwork. On Upwork, it's really, really hard to get jobs. Well, it's not extremely hard, it just takes time, and you might need to do a few jobs for very cheap amounts before you start getting enough testimonials to start making real money on Upwork, because Upwork only want real professionals, people who are really, really skilled at what they do, so that the companies that are going on there, they're charging a lot, or they're paying a lot for the services. So they know that the freelancers on Upwork are really the cream of the crop of freelancers in the world. And I've explained in the video I did on Upwork how they do that, but I'm not going to go through that right now. But the Upwork is essentially more for professionals, and Fiverr is essentially more for kind of side hustlers. Like freelance is like full-time freelance, people who are really committed to whatever they do, software developer or graphic designer or whatever. And Fiverr is more like kind of side hustlers and cheap services. However, I think over the long term, people on the more professional side, like it's kind of a dormant beast that's ready to go. But the side hustlers are doing really well right now on Fiverr. But I think the freelancers on Upwork, and Upwork as a company right now, is just waiting for this to become more and more normalized. And with COVID and everything, the switch to the freelance economy has been accelerated. So I think the side hustlers, because Fiverr is growing really fast, the revenue is growing really fast now. But obviously, so the revenue for Fiverr is growing really, really fast now, but the price to sales ratio is also really high. So I think the kind of side hustle buzz of Fiverr is kind of already taken off, but Upwork, the more professional, has yet to take off, if you know what I mean, because it's easier to pay, $10. Like a small, say, sole trader like me doesn't want to go to a really fancy proper guy to get my graphic design done, so I might just go to Fiverr. But as more and more big companies become normalized with the fact of using freelancers, Upwork should do really, really well, in my opinion. So for that reason, I think Upwork is a little bit better valued than Fiverr at the moment. Fiverr has done really, really well recently and has grown. It's growing really, really fast in both stock price and revenue, so that's great to see. But I think Upwork is ready to go soon as well. Upwork has a market cap of only 2.4 billion and an enormous total addressable market. So I think this could easily be a 10x, if not like 20-30x opportunity over the next 10 years. Price to sales ratio of 7. So that's not a high price to sales ratio in comparisons to the others. However, it's only growing at around 20% a year at the moment. So at best, it's growing at 20% a year. So not an extremely fast grower. However, a much lower price to sales ratio. But at the same time, the price to sales ratio is historically high. So the average price to sales ratio was 4, and now the price to sales ratio is 7. So a little bit richly priced right now, but I've still been buying it. Under $20, I'm going to be buying Upwork, and I might start making it into a more medium-sized position in my portfolio. So they're losing a bit of money, and their expenses are increasing as well every year. But once they start making money, like Fiverr recently switched on their profitability. So I think once Upwork can switch on their profitability, then the stock price should start reflecting that and start doing a lot better, because it hasn't really performed as well as the other stocks that I mentioned today. If you enjoyed the video, I'd hugely appreciate if you could smash the thumbs up button, because it really helps get this small channel off the ground. Really hope you enjoyed, and thank you so much for watching. Can't wait to see you in the next video. Cheers.